Good afternoon, everyone. In today's video, we're going to do a Futures Volatility Box performance update for today, June 4th, 2020. We'll go through almost every single futures market, but we'll try to do so fairly quickly, and we'll cover where we actually had trade setups. So today we had two trade setups in the Russell, both of which were winners for a total gain of 1405. And then we also had one trade in copper, which had a slightly smaller risk that was involved, but only hit our first target, and that was good for a positive 175. No losers today, but we did have some missed opportunities in terms of trades that we missed because of our rules. But you'll also see where our rules help to stay on the right side of the market, places like, say, the 30-year bond. We'll cover all those charts in this video and go through each of these charts fairly quickly to show you some of these trade opportunities. So starting with the S&P here, we'll start by drawing our first hour line test, and we check to see whether or not we've breached either side's entry lines. We very clearly had here, and that's where our first hour test now comes in. So we'll also load in our trader assistant here to try and make this a little easier and more objective. So if I load that in, we should see chart bubbles here, yep, where it tells you very clearly, right? If we see 3,114.25 first, then you can continue using the more aggressive models. And if instead we see 3122.50 first, then you know that, hey, it's time to switch on over to a slightly more aggressive model. So in the case of the S&P, we stopped outside of our volatility box clouds before we ended up hitting this first level for the aggressive zone. And that's where the market is telling us. The S&P is telling us that, hey, we're slightly more volatile. Before you have any capital at risk, why don't you go ahead and be a little bit smarter and use a slightly more aggressive model? So if we load in the aggressive volatility box model here, which is our next most aggressive model, then we can see that this did a much better job of containing price action in that first hour, right? In the case of our aggressive volatility box, we did not breach either side's aggressive volatility box lines. And that's where you have your permission to continue to use the aggressive models, looking for breaches of either side's entry lines as the day progresses. Now, in the case of the S&P, we didn't see that. And so if we keep going on to the next chart, which let's go with the Dow, and we'll load back in our Scalper Volatility Box, but now we'll go through this a little bit quicker, right? So what we should notice here in the case of the Dow is we didn't breach our entry lines in that first hour, so that was our permission to continue to use the scalper models. We're now looking for breaches, which came in the 8 to 9 a.m. Pacific hour. So if we zoom in here, this is where we're waiting for price action to hit our cyan entry lines, which it did right here. And from this point, we're waiting for an edge signal before we stop outside of our volatility box clouds or hit our target. Right, so once we get that edge signal, then we're waiting for an opportunity to enter at the cyan line or better, looking for then a move to either our target or a stop outside of our volatility box. Now in the case of the Dow, we ended up stopping outside of our clouds before we even got that edge signal. That first edge signal came a few minutes after the stop out, and that's where you have free information one more time to switch on over to the aggressive models. It's really just a stair step down, and this is where you get to adapt to any volatility conditions that are currently happening in the marketplace. And our edge signal, our confirmation signal indicator, keeps us out of trouble more times than not. So using our aggressive models, once again, we're looking for breaches, no breaches in the case of the Dow. And the same way, now if I fast forward to the charts of the Russell, we'll notice something different in the case of the Russell, right? So if I load back in our Scalper Volatility Box models, starting with that first hour, we don't see a breach, and that's your permission to continue using the Scalper Volatility Box models. Keep forwarding through here, and we had a breach in the next hour. We ended up hitting our cyan entry line, and you had a really nice reversal. Now, this was at the edge of an hour, so this wasn't a valid trade for us, but it did help to give us more confidence in the idea that, hey, these models are being respected. Now, as we had our next breach, where price action fell into our volatility box, giving us an opportunity to get long, we're again looking for the same thing, right? Before we stop outside of these models, we'd like to see our edge signal. We don't see that in this case, and that then becomes your sign to switch on over to our aggressive models, looking to try and contain this price action. So now with our aggressive models, we still see the same breach. We're waiting for our edge signal confirmation, which if I keep forwarding, you got your edge signal right here, and that's then our permission to enter this trade at the cyan line or better as long as we don't have a move in the opposite direction of this same distance, which was 5.6 points. And so if we keep zooming forward here, we had an opportunity of retest in which our order got filled to get long the Russell, and we ended up making a move in that 5.6 point direction and then some before the Russell ultimately started to turn back around. Now we're once again looking for another opportunity to enter. And in the case of the Russell, again, we had one more breach, except this time, no edge signal as well before we break outside of even our aggressive models. So again, just stair step down. Our next most aggressive models is our doomsday aggressive. So going to our doomsday aggressive at this point, we see we still broke outside of our volatility box before giving us an edge signal. And so going down one more, That takes us to our conservative models where our risk also starts to increase, but you can see that we give it a much wider range as well. So in the case of the Russell, we had our next breach that took place in which you had price breach in that 10 a.m. to 11 a.m. hour. You had the edge signal. You had plenty of opportunities to enter at the sign line or better, and our trade breach came before that end of hour mark, right? This breach actually happened right around that 10:44 Pacific AM time, and so you had plenty of time to get in before the edge has been reduced. At this point, our stop is outside of the volatility box, and we were looking for at least 9.9 points, which is the same distance from our stop, our bare minimum distance on the opposite side. And our second target is at this gray target line right here, which was 12.6 points away. If I keep forwarding forward, you'll see that the Russell had a really nice puke down lower from our levels. We didn't really have any heat on this trade. And so that trade, using our conservative models, being able to adapt to the volatility, really helped us stay on the right side of the market. And that was really the biggest winner. That trade across both contracts was a positive gain of 1125 out of the entire P&L on the Russell. And so that was the biggest winner of the day. Now, if we keep fast forwarding through, another place where we had a breach, but we didn't get our signals in time in order to participate was in the charts of the gold futures. So if I load in gold here and we go back to today's activity, with the market open with gold, we had a breach of its cyan entry lines using its most aggressive models, but we also saw some really nice follow through, right? And that gave you the okay, the permission, the confidence to continue to use these aggressive models. Now we're looking for a breach, which did come, but that came towards the edge of an hour, a place in which our probabilities are a little bit less, and that's where it's just free information. It's a chance to get to sit back and see whether or not these models are actually working out in the way that we would expect them to without really needing to put any capital at risk. So here in the case of gold, we had our price hit our volatility box line. You had the edge signal. You had an opportunity to re-enter. And again, this was the edge of an hour, so not a valid trade according to the rules. But you can see that gold did have a really nice follow through from that exact point. We've also talked about this as a repeating theme. The idea that gold and that 6 to 7 a.m. hour, that fading opportunity, while a little bit more aggressive, does usually lead to some really nice reversals and gives you that best setup price for the rest of the day. So while a little bit more aggressive here and an edge of hour entry, it was really nice to still see that gold respected the models and gave you the follow through that you would have been looking for, especially if you had gotten this breach towards the middle of the hour. Now, finally, the last few charts that we'll take a look at. So we'll go to our charts of the copper futures, and again, using our most aggressive models. In that first hour, we respected our aggressive volatility box. We're now looking for a breach. You get the breach in copper, you get the edge signal and multiple opportunities to enter, and you had some really nice follow through before that second contract was taken out at break even, but that first contract gave you your positive target, which led to a fairly heat-free trade of a positive 175 in copper. Now, outside of those three markets, we didn't really have opportunities in very many other places. We did see a lot of volatility in the bonds, which I think is worth noting. So if we zoom back out, particularly in the 6 to 7 a.m. hour when the market's open, that's when we saw this great deal of volatility in the bonds. Again, waiting for the edge signal here is the thing that keeps us out of this kind of danger and trying to just pick bottoms, which was right here, because that would have been a grand opening, grand closing trade. But at the end of the day, the only models, if I fast forward, that actually did a good job of capturing that price action was our doomsday conservative. And you can see exactly what happens from when we bounce into our doomsday conservative models, and we're looking for fall through of the opposite distance in the opposite side, which we get. But after that point, we really just chop around sideways where that cyan entry line zone is, almost as that line in the sand in which the market's trying to make up its mind whether or not it'd like to break up higher or continue to trend down lower. So hopefully that exhaustive walkthrough across some of these charts helps to give you an idea of how to use the futures volatility box in a process-driven approach to consistently keep pulling profits out of the marketplace while having a rule set and a set of tools that helps you still have the confidence to know that, hey, despite missing out on some trade opportunities here, you can easily make up for it with your more conservative rule set with higher probabilities and go an entire day with 3 setups and not a single losing trade while still pulling out consistent profits on that first target. All right, good luck trading the rest of this week, everyone. Hope this video helps, and we'll see you in the next update. Take care.